Hello, everyone. Welcome to AAPI Educational Webinar Series about year-end tax planning tips for physicians. AAPI's goal is to educate its members about the importance of financial planning and becoming financially independent. Attendees should consult their own advisors and attorneys for any advice. This is only educational. So this event is hosted by me, and my host is Dr. Ravi Kohli, who is the past president of AAPI. And 2024 is about to end, and we have invited guest speaker Syed Nishat, who will address today mainly about tax planning. So, Syed is a certified financial planner and a certified plan fiduciary advisor. His articles and interviews about asset protection and common financial mistakes by physicians are published in MedPage Today and Medscape. He's regularly quoted and interviewed in media outlets like Forbes, Kevin MD, US News, and you name it. So we would like to make it more audience interactive, not a long and boring presentation. So I'll ask some questions and Nishat will answer. And then Dr. Ravi Kohli will take over after a few questions and he'll be interacting with Nishat and all of you. And you can ask questions as well in the chat box. Again, please ask your questions in the chat box and we'll try to answer them as best as possible. So Nishat, thank you for coming. So before
Thank
we
you.
start speaking about tax planning, some lighter topic. So do you still believe that investors should do passive investment like index funds? They don't need financial advisors for investment only. So can you elaborate on that, please?
Yeah, first of all, thank you, Dr. Kathula and Dr. Kohli, to do this on the Sunday for the RP members. Really appreciate it. And thank you for the thankless job you do. I don't know how
Thank
you do
you.
it, but really appreciate it for the RP members. So thank you, Dr. Kathula and Dr. Kohli. Now, just to elaborate the question, and then, I said the same thing before in API. You don't need to pay fee to the financial advisors. Physicians can buy index funds, like for example, Standard and Poor index funds or QQQ or SPY, and leave it there for long term. And people say to me that, hey, as a financial advisor, you are saying buy SPY, buy QQQ. What if SPY filed for bankruptcy? All my money is gone. I got news for you. If SPY filed for bankruptcy, your house price will become zero, your car price will become zero, and we all have to go back to India and sell pani puri there. So it's impossible. That SPY itself is diversified. There's no rocket science here. The best way to invest it is buy index fund, do something called DCA, dollar cost average. Every time market slowly goes down, buy it. And in the long run, if you hold on to it, you will see that outperforms any financial advisor, any hedge fund people. And that's why it doesn't justify to pay this fee, the 1% or 1.5% that investors pay to invest just money, no other services. So that's why not just for API members, I think if you go to a fiduciary, they will tell you to do passive management, do long-term investment. You can forget about annuity, life insurance, all this nonsense product. You'll be ahead of the game.
Okay, thank you. So why pay a fee to your financial advisors like you when you cannot beat the market and suggesting buying index funds?
Oh, you don't have to. That's
Yeah.
why we are here.
Yeah.
We keep repeating the same thing. You don't have to pay. You can
Hmm.
do it your own. SPY, QQQ, VUG. These are very brand name recognized out there. There's already diversified for you.
Yeah.
You use financial advisor for additional services beside investment. Like for example, my clientele um, they're looking for estate planning. They're looking for tax planning. These fees are included into the investment management. So this is our client. And Dr. Kohli and Dr. Kathula, this simple thing I said, buy index funds, the reason why everyone knows about it, but they don't do it is because it's boring.
Mm.
It's There's no adrenaline rush here. There's no fun here, and there's no WhatsApp here, no Tesla and no Nvidia here. So it's boring, but it's the truth. And we got a huge client. We're in New Jersey, where are you right now? And the client said that he's investing with me, so he doesn't do anything stupid. He just want to giving us some fees. So in the long term, we just tell them what's the right way to invest, so he doesn't put everything into like one like Bitcoin and stuff like that. People do it all the time. It is very simple. The philosophy is simple, but the actual when you try to do it, it is not simple, and that's why people use consultant. It's like going to a trainer sometimes who actually help you to do better in life physically, mentally. You feel good, and that's how people actually pay just to justify it. But again, only for investment purpose, it doesn't make any sense. So again, we are a consultant. We provide a white glove service. If you cannot do it, the things I'm talking about by yourself, feel free to use our service or any other certified financial planner.
Okay. So please tell me about your market outlook and which sector investors should focus on.
Yeah, in terms of the market outlook, obviously there's a huge euphoria going on. One thing just investors should be wary about, like API members, I see it all the time. Like when I see their portfolio, is all they have is five stocks, like Nvidia, Apple, Google, Amazon, Tesla. So all I'm just saying it, at one point the rally will be over. It's not that easy. Like I talk to my clients and they say, hey, I make 50%, I make 60%. So if it's possible to try to buy some index funds, you don't have to put everything into one basket. Now, the sectors we believe that will go higher, those are financials. Try to look financial sectors because this new administration, Trump, they will believe in deregulation. So I think financial sector should do very well. Now, what should I buy? You don't have to buy individual stock like JP Morgan or Citibank. You can buy XLF, which is the ETF for the whole financial. We also believe that construction sector should start to pick up a little bit. So try to get into some construction sector like XLI, that should do very well. It has Caterpillar, John Deere in it. And also try to get into utility sector if you can. Like everyone is going for AI. Just to let you know, AI is already up. Everyone knows about it. But the sector that will benefit from AI, they are utility sectors. So companies like Con Edison, or Eaton. So you can buy the ETF called XLU. If you just buy it and leave it there, that will get the boost in the portfolio because of the AI sector. That sector should go higher. So again, the sectors to emphasize on are financial, utility, and construction. Tech is up a lot. Just to give you an idea, in 2 years, the market is up not 1 or 2%, 50%. 50%, like 25 this 20 is insanity. I think it will have some correction. So one advice I have is those who close to retirement need the money, try to like be in 80-20, like 80% equity, 20% bonds. If your children need the money from 5 to 9, take it out next year, because you need the money.
Right.
But if you are young, like you or Dr. Kohli, that have 20 years to retire, those, just leave it there for long term. Don't have to time the market. Hopefully, you'll be the head of the game.
Okay. So what do you think about crypto? I mean, there's a lot of optimism about crypto with Trump being the president. So what's your take on that?
Yeah, so as of right now, crypto is going up because everyone is buying it. There is the regulation hasn't started yet, and obviously the president, made a comment about capital gain about this, and it rallied up like double digit. I do have a part of a portfolio is fine, but my concern is if you put 50% of the portfolio into this. That's what my concern. A part of portfolio like 2%, it's okay. 1% is okay to put into it. But people are becoming greedy and they're looking for short-term profit and putting so much money into it. And all you need, like we have, multiple example, like Intel fell 30%, Boeing fell. No one thought, or Disney, they have a problem with the government. So any stack can go down like crazy. So that's why my recommendation, a portion of the portfolio is fine, but not like heavy concentration.
Awesome. Thank you. So going back to tax planning, as a certified financial planner, can you explain what is estimated taxes and how it works?
Yeah. So one thing, I think number one things to look for, because today's webinar is about tax planning. So before the year end, one thing to focus on is something called to make sure that you have paid your estimated taxes, like W-2 or self-employment, doesn't matter. A lot of physicians have a misconception that the taxes are due by April. Hey,
Okay.
the tax you haven't paid are due by April, but you have to pay the estimated taxes though, by the way. So that is due by Jan 15th, like, whatever taxes you own. So how much is it? So typically the rule of thumb is 110% whatever taxes you paid last year, that must be paid by Jan 15 if your income is more than 150,000, or you pay 90% of current year taxes, at least that you owe by Jan 15. So these two things are important though. So we do see a lot of penalty in April 15 that you owe taxes and there's an interest in it because you didn't pay the taxes. The W-2 wasn't withheld yet. So make sure that's why what we are doing with sitting down with our client and the CPA and discussing, hey, did the client have any estimated taxes that is due so they can pay it? So there's no penalty and anything due at all.
Okay, thank you. So, a lot of AAPI members are charity minded. So, can you please explain what is charitable lead trust?
Yeah, so charity is extremely important because what happened that after December 31st, you cannot do any charity, right? And
Mm.
a lot of API members want to donate to API, but they don't want to give right away. They want to see that Kathula, how do you do? Then maybe they'll pay. So one way to do it is open something called charitable lead trust. Those who are very charity minded, because in a donor advice fund, or you can give money directly to API, the money is pretty much will be used for charity. But if you're doing 100,000, 150,000, one good vehicle could be charitable lead trust. How does it work? Charitable lead trust, the contribution is the same, 30% of your adjusted gross income. So let's say your income is 1 million, you can contribute $300,000 in it. So the money goes to the charitable lead trust. You can open it before December 31st and fund it. Now, you don't have to give the money from the charitable lead trust to the charity right away. There's a schedule. The schedule is about 5% every year. Like every year, 5%, let's say I choose API, you have to give.
Okay.
So what is the schedule means? 5%, 5% every year. The time frame is 20 years. 20 years, all the money goes back to the charity, like to API. I'm giving examples. So 100% goes to API. But as you and I just explained, you buy index fund, you can invest the money into index fund. Let's say buy SPY. We both know if you buy SPY, the long-term return is 10% per year on average in 20 years. So 5% goes to API, the 5% remains in charity. Whatever the appreciation goes back to the family of the donor tax-free. Again, it is very powerful. If you're charity minded, don't just do donor advice fund. Think about charitable lead trust. Again, the way the process works, you contribute the money, you get the deduction that you need. You don't have to give the money right away to the charity. It's just a 5% minimum every year. You can schedule it. In 20 years, all the money goes to charity. You can invest the money. 10% easily you can make it by index fund by looking at the history. 5% goes to charity, 5% goes back to your family, state tax free. Is very powerful. The deadline obviously is end of the year. API member or non-API member, physician, charity minded, think about charitable lead trust.
Great. So, can you tell us what is state PT tax and how does it work?
Yeah, so one thing I think this is also before December 31st deadline to adopt it. So when Donald Trump became president, the maximum state and local income tax is only 10,000, including property tax. So if you remember, with property tax, state tax max deduction is 10. By the way, if you have your own corporation and you have a S corp, you can elect to pay the same state tax. Like New Jersey, we're sitting right now. You can, if you have your own corporation, you have owe state tax. Don't pay personal name. Elect
Mm.
to pay from the corporation. What's the benefit? The benefit is you get this tax write-off federally from the K1 of the corporation. Again, there's no 10,000 limit there. You can get this write-off from the corporation, but it's not automatic. You have to choose it. You have to go to the website and do it manually. So those who have your own corporation, you owe state taxes, elect to pay the state tax from the corporation. It's called state PTET tax law. Not all state has it. New Jersey, New York. Speak to your CPA if you qualify for it.
Okay. So, what is QBI, Nishat, and why is this important?
Yeah, QBI, qualified business income deduction, also very important for physician because a lot of physicians believe they don't qualify for it. It's a mistake. If you're self-employed, obviously QBI is for self-employed and for real estate. If you're self-employed and your income, adjusted gross income, is below $383,000, and the range is 383 to 483. But just in case if your income somehow after defined benefit contribution, after the charitable contribution, if you can bring it down to 383, on the business income, you can write off 20% of the income as a deduction. So how does it work? Let's say your income is $100,000 business income, you can write off 20% of 100,000, which is $20,000 as a QBID, which is for business. The restriction is the income needs to be for a full QBI, full 20% income needs to be below 383. And after 483, QBI start to phase out. There's also a QBI for real estate as well, which is the second point. There's no income restriction there. After depreciation, if there's any rental income, you can write off 20% of the rent as a deduction. So again, these are the two things. If it's possible, try to lower the income down below 400 if you're self-employed, so you can qualify for QBI.
Okay. Okay. So a lot of physicians invest in real estate, right? So what is cost segregation and how does it help us?
Yeah, cost segregation, this is also something you should do it before year end. A lot of physicians, especially our Gujarati client, actually, they invest into real estate, hotel business. There's a reason for it. Because what happened when you invest into real estate, the house I'm sitting in, Dr. Kohli, the house you're sitting in, the house is becoming older, it start to depreciate. Now, what happened? The depreciation you can get to write off from any income you have it, the passive income you have it. Typical schedule for depreciation for commercial property 39 year, for residential property is 29 year. But the schedule is up to you. If you want to bring it down to 5 years from 39 years, you can do it. So what's the benefit for it? The benefit is that the LLC that owns the real estate becomes negative. All the rental income you collect, you can get to write off from it. But again, if you are person who invests into real estate, cost segregation is very important. If you invest into motel, commercial real estate, or if you have your own practice and then you practice own the building, that's more powerful. Like we had a client in Texas, open up an urgent care, own the real estate, $1 million, the client bought it. We did a cost segregation. We get 300,000 negative K1 from the LLC of the real estate. Up to 300,000, the client can pay the rent to the real estate they own. They pay no taxes in it. So again, if you own a lot of real estate, if you want advanced depreciation, make sure you speak to the CPA if cost segregation makes sense for you. That needs to be done before year end.
Okay. So, yeah, I have some other questions. What is defined benefit plan, cash balance plan, and how does it work?
Yeah, defined benefit plan. A lot of physicians for AAPI, non-AAPI, they actually have locum income, 1099 income. So if you're looking for tax deduction, but the technically the American is tax deferral. So if you are looking for tax deferral, a lot of people do SEP-IRA. SEP-IRA, the maximum contribution about 25% of your adjusted gross income ballpark. But if you have a lot of local income, you can think about defined benefit plan. In a defined benefit plan, 52 years old, can contribute almost in the vicinity about $200,000, and that money is completely tax deductible. So again, defined benefit plan is very powerful if you're looking for a lot of tax deferral. So the chart is there, 40% of 193,000 at the age of 52, you can contribute every year $77,000 tax deferral is very, very powerful. The problem with defined benefit plan, once you open, you should keep it open for a few years. You cannot just open and close it. And if there's an employee, they do qualify for it. But again, if you're looking for a lot of tax deduction, besides SEP-IRA, you can open up a defined benefit plan. But that paperwork, there's a Secure Act came in, but we do recommend to do it before year end because this is the math, the actual calculation is based on your W-2, which should be up and down. So we recommend do it before year end.
Okay. So this is a common question, actually. If I'm self-employed or doing locums, for example, how to decide, LLC or S corp versus C corp. So how do we decide on that?
Yeah, it's a very powerful question, and a lot of physician we see RP members they are self-employed, and all they are in LLC or Schedule C, and their income is let's say $200,000, and we still see Schedule C. I think it's a mistake, because what happened that if your income is below 100, I think Schedule C or LLC is fine. So how does it work? Beside S corporation and LLC. Just an example here. Let's say a self-employed individual. who's doing locum, you income is $200,000. So what you do, if you're just an LLC in $200,000, as a W-2, you pay Medicare and Social Security tax, which is about 25,000. You know what happened? The math is $166,000. Basically, what happened is you have to pay full Social Security, but Medicare tax, which is 3.8%, is there's no limit to it. Any schedules you have it, 3.8% you have to keep paying. But by the way, if you same $200,000 income, if you just change it to S corporation, I'm giving an example. You pay yourself a salary of $100,000. That's it, and the rest $100,000 you can take as a K1. S corporation allows it. Remember, Schedule C or C corporation, you have to pretty much take everything as W-2, or Schedule C, everything is subject to Medicare tax, right? And Social Security tax up to 166. But if you're an S corporation, you can take 100,000 as a W-2. You only pay about $15,000 Social Security tax, but Medicare tax you save, which is 4% of $100,000. So again, is extremely, extremely powerful. Plus, the Social Security taxes will be only in 100,000. So if I do the math in a $200,000 income, almost $10,000 savings every year in Social Security and Medicare tax. So the rule of thumb is below 100, stay with LLC, Schedule C. Over 100 to 200, speak to your CPA if S corporation makes sense for you or not.
Okay, that's great. Thank you. So, what is RMD, or requirement minimum distribution?
Yeah, so RMD, required minimum distribution, a physician or non-physician who are over the age of 73 and a half, they must take it. So a required minimum distribution, the amount becomes around 3% to 4% of the value of last year ballpark. So that you must take required minimum distribution is an IRS requirement. After the age of 73 and a half, you must do it. There are a few things you can do to lower the taxes in RMD. Like, for example, like I mentioned, a lot of physicians are charity minded. Instead of taking RMD to your individual name, consider contributing directly from the retirement account to a charity. It's called QCD. It's a qualified charitable distribution that is applicable for IRA or 401k. You can just directly, let's say, for example, AAPI, give it to AAPI. What's the benefit? The income never came into your hand. So again, save you money in taxes. Number two, if you have a lot of huge retirement account, think about Roth conversion. If your tax bracket is low and if you have some stock, like for example, Intel, if you have it, you think Intel will go high. One example could be do a partial Roth conversion. Once you convert the money into a Roth IRA, the money go tax free. And in a Roth IRA, there's no RMD. There's the one way to lower the RMD. Charitable contribution after you have done, RMD, like I mentioned, charitable lead trust, you can contribute into a charity. It kind of negate the RMD that you get it. And again, the money is in your control. In a charitable contribution, you can invest the money, give it to the charity. And also one more recommendation I have it, when you try to do RMD, try to do in-kind distribution. What I mean by that, don't just sell the stock and take money out. Let's say if you have NVIDIA, I'm giving an example, do an in-kind distribution to a brokerage account to NVIDIA. Now NVIDIA have a new cost basis, and you leave it there for long term, and then you sell it. You only actually pay 20% long-term capital gain. So there are a few strategy: QCD, Roth conversion, charitable contribution, in-kind distribution. RMD must be taken before year end. So speak to your CPA if you have taken your RMD, if you're that age or not.
These are all great points and explanation, Nishat. And let's see if we have any questions from audience. If you have any questions, please put
I
them in the
have about
chat
12
box.
questions. Yeah, there are
Okay,
12
okay.
questions
Somehow
in
I'm
the.
not actually seeing them.
It's okay.
So
Yeah.
I would like to welcome Dr. Ravi Kohli, who is the past president of AAPI, to take over from here. So I have to catch a flight. So thank you all for joining, and thank you, Syed, for doing this important session before the end of the year. Physicians are good at making money, but not so good at managing it, especially people like me. But this is definitely helpful, and I would like to, ask Dr. Ravi Kohli to take over. So thank you all. Appreciate that.
All right.
And,
Thank you very
it's
much,
my
Dr.
pleasure.
Kathula.
Yeah. Thank you, Dr. Kathula, for a fantastic job you're doing for
Thank you.
AAPI. And Syed, thank you so much for your support of AAPI. We all appreciate your steadfast loyalty and support to AAPI and AAPI physicians.
Sure.
Thank you, Dr. Kathula, for giving me this opportunity. I know you have to catch a flight. Syed, there are about 13 questions in the Q&A. Do you want to take a stab at them?
Sure.
Do you want me to? Yeah.
Sure.
I won't name the names because of the questionnaires, because with some of them don't want to be named on the recording.
Yeah.
So I'll read the first question. When filing tax returns on SLAT, SLAT, do we lose the preferential LTCG and qualified dividend tax rates?
Yeah, when you file for taxes, it's always like, the individual for tax regarded is a grantor taxes. So the tax filing still should be under your name, so you don't really lose the. But when you gift it to SLAT or irrevocable trust, remember you lose the step up in cost basis, okay? But for tax filing, it should be still under grantor, like what you have paid. Like for example, you're filing the tax, it should be the same way.
Yeah, we have plenty of questions are streaming in. There are 26 questions now. Next question, how about tax advantaged funds of muni funds instead of index funds?
Yeah, so why mutual funds, right? So
Right.
what you can do, you can buy muni funds, like you mentioned, like you can buy, for example, Pennsylvania, Dr. Kohli, where you are, they have a Pennsylvania Turnpike, New Jersey Turnpike, a single muni fund. You just buy it, single muni fund, and hold it till maturity. Principal, return, both are safe as long as that doesn't file for bankruptcy. Just make sure you have AAA rating. I think it's a great idea.
Right. I guess you would be putting some money in the muni fund, some in the index funds as
Correct,
well,
you do.
depending on your age group,
Age
right?
group.
Yeah,
Correct.
right. And next one, name index funds. I think you did name some funds, but do you want to name some index funds? I know VO, QQQ. Anything else you want to add to that list of index funds? One of the doctor asked that question.
Yeah, I think a generic, like a specific recommendation, I think may not be prudent, but an example could be a VOO, Vanguard 500 index fund. iShares are there for index funds. VUG, for example, those are there. IXUX, those are there for international. A lot of clients wants to invest into India, for example, EPI are
Mm,
good ETF as well. So again, we cannot be that specific in a webinar. It's educational, but
right,
they can
right.
talk to their advisor.
So let me put my question here. What is the difference between the index funds and weighted index fund? Do you want to tell a little bit about it? I know it's a lot there to parse, but quickly.
So index fund is basically a passive management. So
Mm,
this is something, there's no mutual funds, there are no active management there. So the fees are 0.04%. Now the weighted one you spoke about, that's an average. There's a different type of index fund out there. There's an average, weighted average S&P 500 index funds as well. So we believe that just buy simple plain vanilla, index fund that just mirrored S&P, and
okay.
that should be okay.
Okay, good. Next question, long question here. Current estate tax exemption for 2025 is approximately 14 million per person. Let's say someone puts 5 million into SLAT today. Let's say that estate tax exemption drops to 7 million in the future. How much exemption is remaining would that person have after estate exemption drops to 7 million? Would that person have only 2 million remaining or would they have 7 million remaining? So
Yeah,
basically, he's asking how do you take advantage of the current tax rates of a state versus possibly potentially change of tax rates?
Yeah, so if you, so currently is a ballpark is about 18 million. So let's say you put 5 million, that money is out of your state. But for math purpose, let's say the state dropped to 7 million, whenever a particular year you're looking for, the 5 million is grandfathered, nothing to worry about. But then the amount is only 7 million. So the issue is that you already have used 5 million. So then you have left over 2 million. So that much you can contribute, but whatever growth happen, 5 million becomes 20 million, doesn't matter because it's out of your state.
Okay, that's good. What has been your returns compared to S&P? That's what one of the question was.
It
I
is,
don't.
but yeah, I don't think that's this is something. I mean, because
Right.
it all depends on individual. Yeah,
Correct. Right. Each individual has their
each
own
individual
preference. Right.
preference. Yeah,
Risk tolerance and all that.
yeah.
Okay. Next question. Mass deportation on the Trump plan and construction is dependent upon these workers. How will that affect the construction? That's a very good question. Any
Yeah.
idea?
So we believe that one of the challenges I think is happening that Trump believe or administration believe in America first. So and tariffs are coming if you see it. So the inflation may spike up because of this, like the question something asked. So
Mhm.
it is if that happens, the construction costs will go higher. That's the
Mhm.
problem, though.
Right.
And so the inflation may shoots up. So that's the challenge. So that's why we believe that the market went up too quickly, 50%. We believe these are the challenges are there, and we believe that the market should go for correction when the politicians start to use all these verbiages.
Right. So I don't know how much is rhetoric, how much is really actionable. We don't
Correct.
know. We'll see. Yeah.
Correct.
Next question. What are the advantages of CLT compared to DAF?
Yeah. So charitable lead trust, as I mentioned,
Yeah.
DEF, but basically there is no attorney there, nothing. You can open up charitable lead trust is like a foundation. An advantage of charitable lead trust, the money can go back to your family, whatever the
Mhm.
appreciation. Donor
Right.
advice fund, there's no cost to it, but nothing goes back to your family. So
Right.
that's the main difference.
Yeah. I mean, while you're at it, CLT, can you a little bit give you an example difference between CLT and CRT? Reminder
Yeah,
trust.
sure. CLT is a charitable lead trust. So the way
Hmm.
the process work, you contribute the money every year. Money goes to the charity, and whatever
Hmm.
leftover goes to is lead into to your family. That's called as lead trust.
Right.
Okay, now there's something called CRT, charitable remainder trust. So what happened? You put the money into the charitable remainder trust. That is opposite. That gives you income. So every year 5% comes to you. Whatever money left over goes to the charity. That's the
Okay.
as the opposite. So who's the ideal candidate? So charitable remainder trust, like the one you ask, these are for very retiree people, but I want to donate everything to API, for example, but I want some rental retirement income. Can I get it? So that is
Right.
charitable remainder trust that give you income for you. Whatever leftover goes to API. But
Right.
you, let's say, have a lot of estate taxes that's due, and you want to give it to your family, and you want to give it to API slowly. I'm giving example, just charitable lead trust.
Okay. Okay. Got it. You made it very clear to me
Yeah,
now.
yeah.
Okay. Next question is index fund is okay for tax-free retirement account, but would you recommend ETF or an index fund for regular brokerage account?
Sure.
That's one.
Yeah, ETF absolutely fine too. Eventually, everything will be ETF based, but yeah,
Right.
ETF is fine.
Okay. Next question. How charitable lead trust is different from donor? I think you already
Yeah, I
answered
just
that.
answered correct.
What happens to cost segregation if you sell the property? Next question.
Yeah, it's a good question. So what happened when you do cost segregation? All you're doing, remember, is just taking the depreciation in advance. That's what you're doing,
Mhm.
right? So your cost basis goes down. So for example, it's $100,000. You buy a property, you did a cost segregation, and you got $30,000 advance depreciation. Your cost basis is $70,000 because you took the depreciation in advance. So if you're willing to sell the property less than 5 years, is a bad idea. You have to hold it for long, at least more than 5 years, to make sense. So that's why cost segregation doesn't make sense if you're looking to flip it. Now, one option could be for cost segregation. You can do a 1031 exchange when you sell the property. So in this way, the same logic applies. So that could be one way of handling it.
Right. Next question is a lot of very good questions are coming fast and here. W2 employees, taxes are deducted at the source. However, on dividends, interest on CDs, no taxes are held. Should estimated taxes be paid on interest, dividend, if dividends plus interest above certain amount, for example, 50K, should estimated tax be paid prior to January 15th? I think they had to be paid every quarter, right?
Every
That's
quarter,
why.
correct. Yeah,
Yeah,
every quarter you pay, but by Jan 15, all should be paid. That's all
right.
I'm saying. And so the CPA, if you call the CPA and say, hey, my statement shows, like right now, all the statements we are sending it to client, it says the dividend, how much it
Right.
came in. So,
Right.
so it needs to be added to the adjusted gross income. This is how much estimated taxes needs to be due.
Right. All right. Why do you not believe in life insurance?
Well,
That's a very good question.
I do. I believe it for
The-
death benefit.
Yeah, I think the way to parse this question, do you believe in term life insurance or like a variable life insurance? What is a better option in your
Term
opinion?
life, always term life for investment purpose, and
Right,
then go for 20 years term life.
right,
I yet to see any clients invest money into whole life or VUL made money. I yet to see it in 17 years. So it's always term life with the
yeah,
so all term life had the option to convert it within certain period to whole life, and the health is lock. All
right,
most of it, all right? And the
right,
difference of premium, you should buy index funds or ETF. You'll be
right.
ahead of the game, trust me. So 5 million, 10 million term life, the difference of the premium buy ETF index funds in the long run makes you a lot of money.
Right. Next question. Should the money be left behind in 529 if not needed for the next generation to use it?
Yeah, the
That's a
five to
good
nine
question.
could be. Yeah, the money left over for you
Right.
can share your grandchildren, but now Secure Act 2.0 came in. According to the
Uh-huh.
Secure Act, up to $35,000 per year. There's a more rules to it, but up to
Right.
$35,000 ballpark, you can put into Roth IRA for that child as well.
Okay. So is there any high ceiling for 529 or no?
Yeah, every year, remember the same gift taxes, which is
Correct.
$18,000 per child times two,
Oh,
36, and you can
right.
pre-fund at five times five.
Okay.
You
Okay.
can do it.
Okay. Next question was not just a question, it's about recording. Yes, it is being recorded and you'll be receiving it.
Yeah.
Next question, thoughts on revocable trusts
Yeah, we had a huge
versus,
webinar about that last time, if you
right,
remember. So that
right,
will be a
right,
webinar of its own. But yeah, you should have a revocable trust. It avoids probate. Very important.
right. Simple question. Next one, traditional versus Roth. I mean, yeah, depends on your, yeah, go
Of your
ahead and ask.
income, depend on your
Right,
income. So if income is high,
right,
traditional, but you can do a backdoor Roth IRA, which we have subsequent
right.
slide. Roth IRA is very important too.
Okay. Um, do you want, let's see, we have a lot of questions still. Let
I
me
think
ask you a few.
yeah, a couple
Yeah,
of more. Then let's just finish the presentation and we can go back if we have
okay.
time.
Absolutely. That sounds better. Okay. Cost segregation, is it only for short-term rentals, for long-term rentals when one does not have real estate professional status? I think you already answered it, but if you
Long
want
term,
it,
long term
yeah,
is
okay,
for long term people. Yes,
all right. So let's go back to presentation and then come back to the questions.
correct.
Okay, my next question is, I have a lot of concentrated positions like NVIDIA, like you said, on a low-cost basis. What can you do to lower the taxes?
Yeah, a couple of things you can do. You have a lot of NVIDIA, and let's say NVIDIA, this money you have it, you don't need it. I'm giving an example. Let's say I had a client recently, net worth 20 million. The client had about 10 million, no, sorry, about 2 million into this concentrated stock, NVIDIA. But the client doesn't care. He just want to give it to the children. Again, 20 million, 2 million was an NVIDIA, giving an example. And the client wants to give it to the children. One option could be let's leave it into a revocable trust. And the client cost basis is really low. The client bought it like a million or something, and a million profit. One option could be if you don't need the money for retirement, if you're okay to take a risk and give it to the next generation, you leave it into a trust, revocable trust. What's the advantage? So if you don't care about this money for long term anyway, once the children inherit the money, they get a step up in cost basis. So 2 million become 1 million becomes 2 million. $1 million that person heirs will pay no taxes. It's a new step up in cost basis 2 million. So again, if you want to gift it, leave it to a revocable trust. If you think long term Nvidia will go high, I know it's more risky, but obviously your situation, everyone's situation is different. If it makes sense. Number two, you
Right,
can do something called a tax loss harvesting. Like if you have a lot of Nvidia, but let's say you bought companies like I don't know, SMCI or Intel, they are down. Sell those companies, use the loss and try to offset and try to lower the concentrated position of NVIDIA. I'm
right,
giving example concentration. Third option could be you can do exchange funds. It's not something like, you can buy, similar. So there you can Google it, exchange funds for capital gain. So if you have a concentrated position, you can buy and exchange mutual funds and it defer the taxes. The problem with exchange funds, it comes with a lockup and everything. Not all good funds are there. So again, exchange funds, one more idea. And this third, for another fourth option could be that donate the appreciated stock to donor advised fund or API. I think API can take the shares too. I think and
Isn't
that
it?
becomes a donation. Or CLAT, charitable lead annuity trust, like I mentioned, you can donate it there. The benefit is the cost basis also get donation there, and you get the deduction as well. So very powerful if you're charity minded. So again, you can
Right.
leave it to the revocable trust for the heirs to get a step up. You can sell some other losing stock and try to sell Nvidia. You can do an exchange funds, or you can donate to
Right.
charity or directly like API or CLAT. The actual stock, don't sell it, give the appreciated stock.
Okay. Excellent. I think you touched on tax loss harvesting. Why is it important before the year end?
Yeah, so I think tax loss harvesting, as I mentioned, that before year end you should do it, is because for this particular year, if you have particular stock, you can sell it up to $3,000. You can just write it from your personal income, and the rest carry forward. So at least if you don't have anything, take some loss up to 3,000. It carries from us. You can write it off from your regular income.
Okay. Next question is, if I'm all W-2, any year-end tax planning tips?
Yeah, unfortunately, I say it that if you're W-2, you're pretty much kind of screwed, So, I see a lot of presentation from financial advisor on the stage, do this, do that. They're all nonsense. Trust me, there is no magic bullet there, Dr. Kohli. If you're W-2, we are done. This is reality.
Yeah,
But what you can do, you can do a 401k and 457 max out. Call your
right,
HR, make sure you're deducting the max you can. A couple of things, HSA account, it helps somewhat. HSA, like, health savings account, high deductible. Most physicians treat themselves, the API members. So maybe HSA account is fine. And you can contribute for the family $8,300 pre-tax, and after the age of 66 you can use it for non-health reason as well. So HSA, talk to the employer.
right.
Donation definitely helps, again, if you're charity minded. And there's some private practice offers something called executive bonus plan. 412I plans like this, where you can defer like almost 50-60% of your income. But again, if you don't need the money, it's a tax deferral, though not really deduction. So W2 employees, all you can do call wise investment, which is called real estate and everything. Unfortunately, from a deduction point of view, the government really tied up your hand.
Yeah, one thought I had always was have a side hustle and make some money, and you can put that all in defined benefit. That's
Correct.
one for W-2 guys, right?
Yes,
Yeah,
do some locum. We need 1099 to do something. All
right,
W2, we are very, very tough.
right. So any other tax planning that should be considered by before the year ending?
Yeah, so this is like a called the master slide. Dr. Kohli, all API member can just take a picture of this.
Mm,
And this is a good summary to conclude. Number one, pay estimated taxes. Number two, charity donor advice fund before December. And after December, you can do cost segregation for real estate if you're a real estate owner. QBI for real estate personal income. Try to have your personal income, business I'm talking about, below 385 so you can get full QBI. A bigger car, by the way, is still there, Dr. Kohli. If you have your own locum and stuff, if you need to use car for business, right now my CPAs are saying it's about 60% the value of the car. If you own it in position before December, you're getting a deduction. So let's say Tesla Model X, the value is $60,000. 60% of $60,000, still CPA is getting it. Next year is going down to 40% of the price of the car. It still is fine. If you buy a regular sedan, it's 25,000. It's okay. So buy a car if you need it. Review S corp versus Schedule C. That's also important. So if your income is below 100, Schedule C is fine. LLC is fine. Over 100, close to 200, S corp. Defined benefit plan, like you mentioned, HSA, solo 401k. Do it before December 31st. Take RMD, don't miss out before. That's also due to have to take it out before that. Roth conversion, if some of the stocks are down, and if you're low tax bracket right now, do a Roth conversion. Also backdoor Roth IRA. So backdoor Roth IRA, just to again reemphasize, you can open up a post-tax IRA account, put around close to $8,000 if you're over the age of 50, and you can convert immediately the money into a Roth IRA. As long as there's no IRA account open, backdoor Roth IRA is fine, and it's very powerful. You can do it. What couple of more things, give to the children. By the way, if you don't want to do 5 to 9, you can just gift it to the children. 18,000 to the individual name. The money is
right,
out of your state. So
right.
and then 5 to 9 contribution is important because some state has a deduction, like your state, Dr. Kohli, Pennsylvania have a state tax deduction. New York has
Right.
a state tax deduction. That's very good. And lastly, tax loss harvesting. Like if you have any
Right.
stock which are down, sell it and carry forward the loss, use it as against a profit. So this is about 12 most important. I'm sure there are more to it, but this should
Right.
be a good starting point. Sit down with your CPA before year end. Make sure you don't miss out anything.
Syed's contact number is also on the slide. Please note, and also the 18,000. You and your spouse, both of you can give it, right? The so
36.
36,000. Yeah,
Yeah,
that's good.
absolutely.
So one question, then we'll go to the finally to the audience questions. What is fiduciary? What credentials should we look in a financial advisor?
Yeah, you'll be surprised, Dr. Kohli. Not every financial advisor is certified. You'll be
Mm-hmm.
surprised. Everyone say I'm a financial advisor. Okay,
Mm-hmm.
there's no guarantee that CFPs are the best, but what we are saying is make sure you ask the question: Are you a certified financial planner, or you just took a license of securities and calling yourself a financial planner? So most CFPs, CFA, they have the highest level of fiduciary standard. If you have a lot of complaint, you cannot have a CFP. So make sure that you ask the question: Are you certified? Like you are a physician is equivalent to like a board certified. So similarly, make sure it's a certified financial planner or are you a certified financial analyst? And that give you most likely that person is doing a good job if they're certified and there's no complaint. So the importance of fiduciary at that times comes into play. They will give you impartial, advice. In your
Right.
situation, like we have a lot of API members call, we are not a good fit. We just tell them the do it yourself. I mean, I think a lot of people will vouch for it. That we tell them, okay, you know what, this is your situation, just do it yourself. Here's an attorney call, just do it yourself. So that's the way it's supposed to be.
Yeah.
So make sure that you ask the question: Are you certified? Are you a true fiduciary? And that do you have the team under one umbrella very efficiently, or are you just a stockbroker who just calling yourself a financial advisor? So less than 30% people are CFP in America. So a ballpark. So make sure that just ask the right question, ask credential, ask experience, go to FINRA, go to SSC, check their background.
One question that came through a message, Dr. Chakravarti. I was told by CPA that once you're on Medicare, you cannot do HSA. Do you have any
Yes,
thoughts on that?
yes. Once you're Medicare, after you
Yeah.
can't. Yes,
Right.
that's true.
That's true. Okay, let's go back to the audience questions because there's so many and so many of them are somewhat been answered by you already. But let's go through and see if we have any questions that are fresh and that need some explanation by you now. So yeah, you'll get the recording. And what is your opinion about investing in yield max funds? Yeah, tell me about it. For example, Tesla has a yield max fund. Do you want to talk about it?
Yeah, yield mix funds are okay. It just like we personally haven't done it. Uh,
Mm-hmm.
so so for example, NLY, I'm giving an example. They are like giving a huge yield. But what
Mm-hmm.
happened that NLY the price keep going drop at the time they give the yield. So
Right.
there's a lot of yield max funds out there give huge dividends, but
Right.
it's sensitive to interest rate. So as long as you
Right.
understand, you're okay.
Right. I think they're probably in a lot of corporate junk bond type of assets, probably they hold.
Exactly.
So,
So it's
yeah,
impossible to understand,
right,
what their underlying holding. But I'm just giving example that's one of those people are buying,
right,
NLY and stuff like that.
right,
And there's a ETF that yield max ETF. But the issue is that underneath holding can change anytime.
right,
So it's hard to predict.
right. So, one of the questions, can you explain more about in-kind distribution? You kind of mentioned it, but I think it needs a little bit more explanation.
Yeah, so whatever the RMD is due, you have
Mm-hmm.
to take either cash or take money out, right? So if you have some
Mm-hmm.
depreciated stock, not appreciated, some depreciated stock you think will go high,
Mm-hmm.
one option could be you can do an in-kind distribution. I'm giving an example. Let's say you have Intel, and Intel is down. You think it will in the long run will go up, so you can just take the in-kind distribution to a brokerage account. The benefit is that the RMD didn't suffice. Now Intel goes back up. It goes back up. Have a new cost basis. So that's what we're trying to explain.
Right. I think one of the question was best way to minimize tax capital gains of appreciated assets in family limited partnership. Any thoughts on that, FLP?
I'm not sure what it means. The
Okay,
capital gain, assets and family limited partnership. I mean, FLP, if you gift it, again, you lose the step up and cost basis.
correct.
So not sure. Yeah.
Okay. I think one of the questions you already answered, but
Yeah.
can we get money back to us from charitable trust?
Yeah.
I think
Remember
that's
the
a
charitable lead
QLT,
trust. Yeah.
CLTs, yeah.
Yeah.
CRT, no, but CLT, yes.
Correct.
Okay. What is the depreciation recapture tax at the time of selling real estate?
Yeah, remember that if you do a cost segregation,
Right.
so the cost basis goes down, so you just have to recapture. So that's called the
Hmm.
recapture. You have to pay taxes. So that's why less than 5 years cost segregation doesn't make sense.
Right.
It needs to be for long term because the depreciation needs to be recapture.
Right. Next question, you can probably answer them later. Can you help with tax planning and estate planning only? If yes, what is your fee, etc.? You want to mention here, or you want to?
Yeah, so we are a full service, and in terms of our service, it comes like everything under one umbrella. So I'm a certified financial planner. So we cannot just do tax planning and estate planning. It comes with a minimum investment requirement. So that's but for RP members, we're still doing this webinar pro bono. Hopefully, you can use some of this and just do it yourself. But in order to be our client, there's some minimum investment requirements.
I think you can get an initial consultation with you, and then they can talk to
They
you,
can
and
talk.
you can. Right,
Correct.
right.
Correct.
If someone has a full-time job with W-2 and also has another business with 1099 in an LLC, should the LLC be changed to S corp? How do you want? How should it be restructured? Any thoughts?
Right. So I need to see the income.
Right.
But as I
Unpaid.
said, the income is only like 50, just stay in LLC, Schedule C. But
Right.
if the income is about 200, we would like to see the number 150, 200. S Corp does make sense.
Okay, that's you mentioned in your talk.
Yeah.
To get tax deduction beyond standard deduction of 30,000, how much should I contribute to my charitable account?
Yeah, the amount needs to be like at least over, close to 30, because remember the standard deduction is
Right.
almost double, right? So
Right.
it needs to be amount. So whatever you think next 2 years, like a lot of people contributing to Temple, the market is up right now. So if you have appreciated stock like Temple, API, whatever you're gonna do next year, just do it now and pre-fund it
Right.
into the charity, and try to go 50, 100 so you can itemize the deduction.
I think in that point, I think there was a talk by Trump administration incoming. They will be increasing the salt deduction to 20,000 from
Correct.
10,000.
There's a talk
Okay.
about that too.
Right.
Correct.
Okay. What is the reasonable amount to pay for financial advisor? I think you mentioned, but I know it's kind of tough question in
Yeah,
public
it's a very
answer.
tough question in public, but usually they charge a fee though, fee
Right.
only. So we are fee only, so typically the fee start with zero point 0.9 for a million, and then there's a tier basis.
Right. I think that as the AUM goes up, the
AUM
fees
goes
come
up.
down a little. Yeah. Okay.
Correct.
Good.
Correct.
Okay. What if your base cost is $10 and current stock is $120? What and how to do now?
Yeah, remember that if you have a low cost
Good.
basis, we spoke
It's a
about
good problem to have,
good
I
problem to
guess.
have. Yeah. Charity, one option, put into revocable trust if you don't need the money. And one option could be like, do a tax loss harvesting, or if it's a long-term capital gain, pay. I mean,
Right, right. There's no harm in paying taxes on.
paying taxes from the profit. Yeah,
Right.
right.
Yeah, I think especially thank God. I mean, capital gain taxes are still lower rate than your
Lower.
income. Yeah,
Correct.
yeah.
Correct.
Open 529 in which state or bank? I don't know what that means. I guess it depends
Well,
on which state
which
you
state
live,
you are?
right?
Correct. Which
Yeah.
state you live? Correct.
A Roth conversion will we will have to pay tax on money transfer. How does it save tax?
No. So Roth
It doesn't save
conversion.
tax. Yeah.
Yeah. So basically, what happened is a tax-free growth. That's the whole idea.
Right.
Once you convert it, so you
And
should do it.
tax free withdrawal too.
Yes, exactly. Tax-free withdrawal too.
Right.
So it only makes sense when the market
Right.
is down to do it, or you have
Right.
some stock that are down a lot in the IRA account, but you think you have a lot of pre-tax money. Only then it makes sense.
Yeah, I read somewhere, clarified to me, Syed, if you are, say, converting 100,000 into Roth, you can actually pay 20,000 from that Roth for the taxes and not pay from your own savings, right? Is that an option?
You can, but then it backfires though. I need the full
Right.
money to grow.
Right.
So I just pay your individual from the individual pocket.
Right.
Yeah,
But if you don't have any like a bridge funds to pay taxes, you can do that
you
kind
can.
of.
Correct.
Yeah.
Correct.
Okay. Yeah, tell us, okay, cost segregation. I think you already mentioned about it. International markets have been lagging badly compared to U.S. market for several years. Do you still advise clients to have exposure to international market? If so, approximately what percent to international for the majority of the physician clients you have?
Yeah,
You
the
want to add?
international we are international about 7 to 10%. We're still international.
Mm-hmm,
We are just avoiding China for a bit, but I
mm-hmm,
think that you can take a look into VUG. Is a
mm-hmm,
Vanguard. Sorry, the Vanguard European Fund Index.
mm-hmm.
You can take a look into it. So that's something in the long run will go higher. Also, you get IXUX.
Mm-hmm.
IXUX. So that's something also international that should it's a MSCI Total International. So
Right.
and Vanguard one, the symbol is VGK.
Mm-hmm.
VGK, that's also you can think about it. That should give you some exposure, but we just avoiding international in terms of China, and a lot of U.S. market has indirect exposure to international. So one of the
Right.
things I see that physicians they put 30% into international, I think is a mistake. I think 7 to 10% is okay.
Right. What about, and I haven't followed the Indian market, but it has some corrections recently.
It,
Indian
it
funds
does.
have done very well, right?
It
Indian funds
does. It
over.
does. And I believe that India is the next superpower, in my
Right.
opinion. So not buying India, I think you should have a little bit of EPI or Wisdom Tree or IFN a little bit in the portfolio because that's the next superpower coming.
Right. Okay. About another question about CLT, does it count against your estate tax exemption?
Yeah, that's the beauty because what happened, the money you put into the CLT, it's a donation, is out of your state. But the thing is that it doesn't count towards the exemption. It's a gift. So
Hmm.
that's the beauty of it.
Okay.
My clients who net worth is one of my clients net worth is 40 million. So what happened going forward income we are putting into the CLT because that money is out of the state and we are not using an exemption at all.
Okay. So there are so many amazing questions coming through here. Can real estate sale gain can be invested in opportunity zone fund? Is there a time limit? Is the whole amount of sale needs to be put in OZ fund or the gain alone?
Yeah, OZ funds, what happened that is a great idea. You can invest into the opportunity zone, and if you hold it for 10 years on the gain, there's no taxes. That's how typically opportunity zone works. And opportunity zone is that the fund invests into an area, but there's a 20% property rate. The problem is I don't see good opportunity zone funds. Most of them are
Right,
the funds I've never heard the name.
right.
So we did it 3, 4 years ago. One of my clients has a lot of capital gain. They bought opportunity zone fund. The returns are
Mhm.
okay. It's just like we don't have a track record. So I do have my concern about opportunity zone fund. But one option could be you can buy directly opportunity zone real estate. If you go
Mm,
to loopnet.com, this website, again, loopnet.com,
mm,
look for opportunity zone, buy hard real estate, like
mm.
the actual real estate. That is much better, in my opinion, rather buying this mutual fund, which
Funds.
we don't know what they're going to do.
Okay. Next question. If one donates 500,000 appreciated mutual fund to charitable reminder trust, do you have to pay capital gains? And how much can you deduct from your taxes in the first year?
Yeah. So again, this is a very very trick, not a trick question, but the answer will be a little bit more detailed. So in a nutshell, what happened if you put 500,000 appreciated mutual fund into the charitable trust, you do get deduction, but the deduction is not 100% though,
Mm,
just to let you know. So there is a present value of the money that will be going out or from the charitable remainder trust. So there's a calculation into it. Typically, so the more is the longevity. Let's say you're going to give 5% in 25 years. The highest percentage is the deduction. So it's not dollar per dollar. It's the actual calculation there, and we have to show it to the client.
okay.
So when you put the money, the goal should be 90% of the money you get deduction. But let's say you put the money into the charitable lead trust. Now the charitable lead trust, what happened? You put the money on the capital gain. Let's say if you have a capital gain, right? you do have to pay taxes in the charitable lead trust. But what happened, it goes back to the family estate tax free. But one thing to do is when you put the money, try to have every year certain amount, let's say bond or some liquid. So only that bare minimum you just have to take it out. You don't have to sell it, so you don't have to worry about paying capital gain. So I know it's a
Right.
long answer, but the reason I have to explain because a more
Right.
detailed discussion is to be happen one on one.
Right. Yeah, I think the best customer is educated customer. I think RP members are really very smart and educated, but they have a lot of questions. Some of them cannot be answered in a short answer,
Short,
but I think
yeah.
you probably should consult or your own advisor or somebody like Syed who are very highly ethical fiduciaries. So they will give you the perfect answer or a longer discussion. Okay, can you describe what estate tax or generation skipping tax would apply for a 529 holder if they change the beneficiary from their child to their grandchild?
Yeah. So the generation skipping trust means that you skip one generation. That's what
Hmm.
generation skipping trust means. So it just the amount needs to be more than whatever the exemption is. So then you have to pay the GST now. Because what happened, you skip a generation, by the way. So what happened, the
Right,
next generation will pay. But most of my client, it's just a provision. GST is there, but no one is paying it because the limit right now is 28 million. You use all
right,
of it. Anything more than that, it goes to the GST. Only then you pay taxes.
right. Is there any other way to offset capital gain on real estate sale besides 1031 exchange?
Remember, if you have a stock, by the way, loss because real estate capital gain is negate again stock market capital loss.
Okay,
So that tax loss harvesting is good.
okay, all right. Are are margin loans advantages than mortgage?
No, I margin loan is very high, 8%. Mortgages, up to certain amount you can deduct it.
Right, mortgage
So
loans are deductibles. Yeah,
deductible, right? So I like
right.
mortgage loans, but you should not
Margins are
be
very tricky. Yeah,
very
tricky
tricky.
business. Yeah,
Yeah, right. But no one should use margin to buy stock or mortgage for sure. Yeah,
especially in this market, they're
in this
so
market,
volatile. Yeah.
correct, correct.
If you want to give 18,000 to your child but want to put it into a trust, which is the best type of trust to use?
Yeah, so if you want to gift it 18,000 to the child, and I think the idea is that you can open up something called a gift trust for the children. Gift trust is like is for the you're gifting it to the child, and that child money is protected if a divorce happen. So it's called gift trust. You can open it. So you can just open it. It's usually it's an irrevocable trust. You can make it revocable for the child, but doesn't make sense. You just want to do an irrevocable. It's a gift trust, family gift trust for the children for using annual exemption. You can just open it. Hopefully, it's not that expensive.
Right. Is it possible to gift parents who are in India who don't have a social security number but actually have no formal income and retire?
Very hard to
Yeah,
prove
it's
all of
a
it. Yeah.
yeah. I have a thought on this. How about if you start a charitable foundation or charitable like a non-profit and fund that and can give that money to some parents or other family members in India or I
We
don't know.
can. The money needs to be used for 501c from there only.
Right. Okay.
Yeah.
Probably Indian tax laws also play a role in that. How to, yeah.
Yeah, that Indian organization we are giving money to, like for example, we have clients who put money into Shankarai Foundation, Mother Teresa.
Right. Right.
So they are registered here. From here, charity, you can give the money to them. That's fine. But what you
Yeah,
cannot
I
do,
think
give it to
the
a relative and stuff. You can do that.
right. I think the tax laws in India have become very strong and stringent, and because the money laundering and all that, you have to be very
Correct.
careful. Yeah. Okay.
Correct.
What is the max you can contribute to 529 plan in a year for a child? I think you did
I
answer
did.
it,
I
but
did.
yeah.
18.
Yeah. All
Yeah,
right.
and you can prepay for 5 years.
Oh, okay. So for 18 times 5, you can put 90,000.
Correct.
Okay, good. Can you put front loading for 529, which is
Correct.
90K plus give 8? Okay.
Correct. We
Are
did.
you taking new client? Of course, you're going to take new clients,
Yes.
right? How many 529 per child can one have? How many? Yeah, you can have as
There's no
many as you
limit. Yeah, as long as the
right,
limit is there.
right. The grandchildren, friends, family, nieces, nephews, anybody you can have,
Correct. Correct.
right? Is appreciation recapture apply to regular depreciation too, or only cost segregation depreciation?
Yeah, so the cost segregation, the recapture is there. The regular depreciation, that's the schedule. You should be fine.
Okay. What is the difference between LLC and S corp from a tax
Yeah,
perspective? And it's a very
we just
basic,
got.
good question. Yeah.
Yeah, we
All
just
right.
answer. The LLC is there's no salary requirement. S corp there is, but the
Okay.
difference is S corp that the W-2 you take, you pay taxes. The K-1 you pay no Medicare tax. LLC, the
Oh,
whole amount you pay Medicare
okay.
tax.
Okay. Very good. The 4% tax you're extra
Correct.
paying.
Correct.
Okay. Um, what do you think of market-linked investment? I think he's talking about like structured notes.
Structure notes. Correct.
Yeah. What do you think
Yeah.
about that?
Yeah, I don't like that either. So I know anything complicated, the bank makes more money. I hate all of this. So
Yeah.
I have invested in it. 5 years been passed. The bank make more money. My clients make like 2% barely.
Yeah.
Yeah.
Okay. In a state like Texas with no state tax, if you convert all your IRA, 5 million, say, still exempt from state tax?
Um, so state tax that doesn't apply in Texas. So that's why a lot of uh, my clients
Retire.
who retire in Texas and Florida because they don't have to worry about state taxes.
Right.
Correct. It's just like New
You still
Jersey,
pay
New
the,
York. Yeah.
yeah.
You still pay the
Yeah.
federal.
Right.
Yeah.
Federal taxes.
Correct.
What is your, is there any local taxes also you have to say? For example, you live in Philadelphia, New York. Do you have to pay any taxes on your IRA
Yeah,
income
so
or not?
remember, yeah, so the RMD, that's the reason,
Uh,
what first thing we ask the question, hey, you want to take RMD, do you want a Roth conversion? First question to ask, are you going to move to Florida or Texas?
right.
If the answer is yeah, I mean, then wait, I mean, you save the 6% New York state tax.
Right. Right.
So that's very, very important.
Right. So, what is your recommendation for small cap, mid cap percentage versus large cap? It's a very specific question. You want to answer that, or you can skip it. It's up to you.
Yeah, it's a small percentage is fine, but in the webinar recording, I cannot say what percentage depending on your
Okay.
situation. Yeah.
Right. Do you advise in crypto and Bitcoin? Again,
We
very
can't, we
yeah,
cannot comment that. Our company doesn't
right,
allow it. Yeah.
right, right. How do we check if my CFP is a fiduciary? How do we check? I guess you can just ask him,
Yes, you
right?
can ask the question. Most CFPs must adhere the fiduciary standard.
Right,
So
right,
I went through like crazy, and most CFP goes through crazy courses on top of. So you have to have a bachelor's degree, certain amount of work experience, clean
right.
license to be a CFP.
And
So
then you have to
that's
maintain it CME credits and all
CME
that
credits and
too.
everything, right? Correct.
Exactly. Just like a physician, it's
That's
a high,
correct.
high requirement.
Correct.
And yeah, Florida is becoming very expensive now. Somebody has can comment on that. Anything you want to say about it?
Yeah, Florida is expensive, but it's still cheaper than New York. I think the price people are saying a lot of
Yeah,
people still moving, price keep going higher.
yeah. Let me say my thing. Look, another question from Dr. Amit. Um, because okay, let me see. Because the income bracket backdoor Roth IRA is not going to be beneficial for high income. I don't know. You want to answer that?
Uh, so remember backdoor Roth IRA, there's no income restriction there. Traditional, you can open a post-tax IRA anytime. So you can just as long as you don't have any IRA account open, you can open up an IRA account, put the money $8,000 post-tax. You file the
Hmm.
tax return that is the post-tax money. Immediately flip it to a Roth IRA. There's no interim restriction there. And once you flip it, the money grows tax-free. Very, very powerful. If you haven't done backdoor Roth IRA, do it.
Okay. I think that's an amazing presentation, and
Thank
we
you.
almost answered 68 questions,
Yes,
almost, I think. And not an 170 people signed in on a Sunday afternoon. Talks about how credible you are, Syed, as an advisor to API and API members. We
sure.
really appreciate it. Anything else you want to say before we part? And happy
Uh,
holidays to you and your family, Syed, and wish you a happy new year, all of you, your team, and you've really been a fantastic friend of API. Thank you.
Thank you, Dr. Kohli, for working on the weekend. Really appreciate it. And thank you, everyone, for joining.
Thank you.
Bye bye.
Have a good. I wish all the API members a great holiday season, a happy New Year, and Merry Christmas. And please continue to support API, and our president, Dr. Kathula, has been doing a fantastic job reaching out to many, many local chapters and many other non-API organizations to bring API to the higher glory And please support him and API. Thank you so much. Have a good day. Bye.
Good day. Bye-bye.